Today we're going to be looking at oscillators, and among the oscillators we're going to be looking at, we're going to look at the RSI, which is also called the relative strength index. We're also going to look at the stochastic, and then lastly I'm going to introduce you to something which they call the parabolic SAR, which is also called the parabolic stop and reverse indicator, stop and reverse indicator. Let me just open up my MT4 and share that and show you how you can put these indicators on your MT4, and furthermore how you can use them in your trading. Okay? So if you have a clean chart like this, how do you put the RSI, and then how do you use it in your trading? At this point, I would find it relevant to reiterate, guys, that you do not use these indicators singularly, individually. We use them as a combination, and we're looking for confluence. Confluence, we said, is when 2 or 3 indicators are telling you to do the same thing. So just to give you a recap, remember, you start by doing your analysis. There are very many ways to do analysis. You can do the fundamental analysis. You can do a technical analysis where you're looking for a bias or a trend. Sometimes this trend is given to us, or bias is given to us by a news item. The news items from the calendar that come out, news, and then it gives you a bias on the strength or weakness of a particular pair or a particular currency. And remember, we're always looking to get a strong currency and pair it with one which is weak, so that we get a strong bias in a particular direction. So for those of you who normally join us in the Wednesday and Sunday analysis, we do the strong weak analysis, and that gives us a bias. So after we get that bias, we open up our pairs and look at them. So is there any particular pair you'd like us to use in today's example of using the stochastics? Please put in the chat or unmute yourself and let me know if there's any particular pair you'd like us to use as an example in our analysis, just to help you or to help all of us to understand better how we could use these oscillators, the stochastic, RSI, and parabolic SAR to make our trades or to make trading decisions. USD card, Julius, thank you. And which direction or bias do you want us to trade this in? Julius, we're going to go with the USD card. Do you have a particular bias or direction? Because you cannot trade without a bias. What bias are we trading the USD card in? Downward. Okay, thank you very much, Julius. So we're going to be looking at the USD card and looking for a downward bias as we go through our trading today. Okay, so I've loaded the USD card pair. This is what we're going to be using in our analysis. Julius, thank you very much for your feedback. And we're going to be looking for action on the downward side. So, like I said, first we need to get our bias. And we've ascertained that our bias, or the bias we're looking for, as we analyze this pair and look for trading opportunities, is we're going to be looking for action on the downside. Okay, so next, remember, if you attended our class on leading and lagging indicators, we said it's always good to have a combination of the two, both the leading and the lagging indicators. And for those of you who are in that class, remember we looked at one of the leading indicators being the candlestick formations, candlestick patterns. Another leading indicator being the pivot points. Another indicator being the Fibonacci lines and the support and resistance lines. Okay, for those of you who missed that class, please consider going to our YouTube channel and rewatching it. It will give you a background on that, because we're going to incorporate that as well. Why we're incorporating that is we do not use any single one indicator alone. We said there's no single indicator that is 100%, a combination of indicators. But that said, we're always looking to combine the leading and the lagging indicators together with our money management for best performance as we do our trading. So our lagging indicator, the lagging indicator is going to be, the first one is going to be the RSI that we're going to look at. Okay. So to plot the RSI on your chart, you come here to the navigator window, and then under oscillators, you select relative strength index, which is this, and you double click it. Okay. Here you can change color, you can play around with its visualization, what color it will be and all that. Okay. And that is this. That is the default, but we could change this to another color, and you see that color will change there. You can also change the strength of these lines. But we shall look at that shortly. So this is our RSI. We've put it on our chart, the USD card chart. And remember, we're looking for action on the downside. Our bias is going to be looking for action on the downside. So in its simplest form, an oscillator simply means something that bounces between two regions. Okay. And for RSI, those two regions are 0 and 100. If you look on this side where my cursor is, you'll see we have a scale from 0 to 100. So this RSI or this line here will always bounce between these 2 points, 0 and 100. That's what oscillating means. Oscillating means to bounce between two places. In a simple definition of oscillating. So oscillators will always be bouncing between two zones. So on the RSI, we always mark out the 70 level and the 30 level. And you see those two levels are marked here. Maybe I can increase the thickness of those lines. So our 30 and 70 zones have been marked out because these are the two most relevant zones as we look at RSI. Okay, maybe we also usually add the 50. Let's just add the 50 as well. The 50 being the midpoint, the midway line. I don't know if that's better. Okay, we've added the 50 as well, the 50, the midway line between 0 and 100. So simply what happens is every time price reaches the 30 line, this 30 line on the RSI, and is trading below or at the 30 line, we consider the price of the currency to be oversold. Keyword oversold. If you have a notebook, write it down, oversold. If price is bouncing and trading at above the 70 line, it is considered to be overbought. Okay, overbought above the 70 line. So those are two key terms as we use oscillators: overbought and oversold. And I'm going to show you how to use them very, very shortly. So when you're looking for action in the downward bias, okay, remember our arrays here, we said we're looking for action in the downward bias. So we're going to be looking for conditions that are overbought. So this is our overbought region, okay? And these are very, very important terms as we use. As we use oscillators. This is our oversold region. Okay. So anything above 70 region, the market is considered to be overbought. And anything at 30 or below 30, the market is considered to be oversold. Okay. Now, usually when price is trading, or the RSI line, relative strength index line, is above the 50 or the midpoint of the levels, the market is considered to be trending upwards. And when RSI is below the 50 level, the market is considered to be trending downwards. So how do you use this to get selling signals? First and foremost, you know your bias is to the downside. So you wait for the market to become overbought. I'll say that again. We know we're looking for action to the downside. We're looking for action to the downside. So if you're using the RSI, you're waiting for the market to become overbought. So we're waiting for this RSI line to come near or at the 70 line, to be trading above the 70 line, and then we see it starting to come back down again. Just for example purposes, I will go back and just highlight an area where this occurred. If we look at an area like this, you see this? If we're looking to move in the downward direction like we are, we're looking for a condition like this where price will come above the 70 line and then begin to come back down. That means we're trying to sell, but we're waiting for the market to be saturated in terms of overbought. So when the market becomes overbought, usually it's too saturated, then sellers come in and take over because the buyers become tired. The market becomes saturated with buyers, so the sellers come and take over. Similarly, when the market is oversold, buyers then come in and take over. But remember, we're looking for a bias downward. So this is very important. You have to know what bias what bias or direction you want to trade. So we shall wait for the market. Now that we know what bias we're looking for, we're going to wait for the market to reach these regions of overbought in terms of the RSI. Now, when it reaches overbought, we begin to look out for selling or shorting opportunities. It doesn't mean that immediately the market becomes overbought or RSI shows us that market is overbought, that immediately we begin to sell. No. We then go back and use our other analysis. We use the candlestick formations. We use the pivot point strategies. We can use any other, or we can use any other indicator as well to help us to determine when and which exact time to buy. Okay. So just to give you some perspective, let me load one of our leading indicators as well. So we simulate real conditions here. And I normally use this pivot point strategy in I normally use it in the Fibonacci form. So we said we're looking for conditions similar to that to happen here, and then we shall be comfortable to buy. We shall become comfortable, to sell. Alternatively, sometimes if we're in the downward market, the price might not reach all the way to overbought, which is the 70 line, but it could turn and then cross back below the 50 line. That could also help us to signal that the market has moved to selling trend. You see, remember we have said if price is trading above the 50 line, it is considered to be a bullish trend. And when price is trading below the 50 line, it is considered to be a bearish trend. So if we're predominantly in a bearish trend, sometimes we might not get all the way to the 70 line, especially on the bigger time frames, but price could stop here at the 50 or around the 50 and begin to turn back downwards. That can also be considered as a signal for us to start looking out for shorting entries. Any questions in regard to how we use RSI? And we can see some of that here. You see at this point, if you see at this point, which I have just marked, the price did not exactly go back all the way to the 70 and come down, but the RSI crossed back below the 50 line. And if you look at our price at this point, we got signals or selling candlesticks forming. So you see, this can be a confirmation for us that we should begin to get short positions or should begin to look for selling entries. So we're going to look for something similar to that here going forward, Julius. If you're looking for shorting opportunities, now what you have to do, if you have the RSI or if you'd like to use the RSI as one of your indicators, you're going to wait to see how it forms. Either it will get all the way to the 70 line and begin to come down. Then you begin to look for candlestick formations or price action, letting you know that you can sell, then you take those opportunities, or it might not get all the way there, but this line could begin to cross back below the 50 line. Then you can take selling opportunities. There are other ways to use the RSI. There are things like using the divergence. Okay, but that's the slightly advanced class. If you'd like to learn about how to use the RSI with divergence, you can join our accelerated program. We cover that as well in there. But now I would like to quickly also come and we look at the stochastic as well as another oscillator that we could use in our trading to help us get good trading signals. If we don't have any questions, I'm going to go ahead and load the stochastic oscillator. Again, you come here under indicators and then under oscillators, you select the stochastic oscillator. Okay. I think the default values you will have here is 553. That is still okay. Personally, I use 1555 and exponential, but pretty much you get almost the same thing. So this is my RSI, and this is honestly my personal preference among the oscillators. I prefer to use the RSI, and you will see I prefer to use the stochastic, and just like the RSI, you will see that it is an oscillator. It bounces between 0 and 100. If you see these levels here, unlike the RSI, which has 30 and 70 as the key levels, the stochastic has 20 and 80 as its key levels. And you will see that they are marked out here. I can just make them a little bolder so we can see them more clearly. Okay, so these are our levels that we use on the stochastic. We use the 20 level and the 80 level. So similar to the RSI, Julius, I've seen your question and I'll come back to it shortly. Similar to using the RSI, the stochastic, when price is trading at the 20 or below the 20 level, the market is considered to be oversold. The market is considered to be oversold, just like we saw earlier, okay? When price is trading at or above the 80 level, the market is considered to be overbought. Okay, so because our bias is on the downward side, we're looking for situations where these are moving average, as if moving average lines, and they are actually moving average lines, where these moving average lines cross over and begin to move, show downward motion, or we're looking for situations where this happens in the overbought region. Okay, every time this happens in the overbought region, we're going to, it means that the buyers are saturated, and that means the sellers are most likely going to come in. So this would be a good signal for you to begin to look for selling opportunities. You're looking for overbought conditions in a downward trend or in a seller's market. However, if you're looking for buying opportunities, then you're going to look for oversold conditions. And that could have been seen here. If anybody had wanted to buy the USD card, when this happened, the market became oversold and then began to get out of the oversold region, you could have begun to look for buying opportunities if your bias had been buying. But remember, because our bias is to move down to the selling side, we would ignore this one. Or if you are already in a trade and then this condition happened, you would know that maybe you need to get out of that trade, take your profits, because the market is going to move up either temporarily or it's going to be a proper reversal, not just a retracement. Guys, it is that in its simplest form, that's how you use the stochastic as well. You can also use it with divergence, but that is a slightly more advanced class. If you'd like to learn about how to use the stochastic divergence as well, maybe you could consider signing up for our accelerated program, and we shall be happy to take you through that because it's part of the course curriculum. Julius, you're asking what can help to avoid false direction when using the RSI. To answer your question, like we've been saying all along, there is no one single indicator that is 100%. So every now and then you will get a few false signals, but to reduce on the number of those false signals, one of the main things you could do is to incorporate confluence, what we call confluence, meaning you do not look at RSI in its singularity. You also look for other indicators to give you the same signal, to give you a go-ahead to take the RSI signal. Okay, so that will help you to minimize on the false signals being given to you by the RSI. Secondly, it's always good to trade in the direction or to have a directional bias. Like we said, you first get a directional bias, so you don't take all signals. You only take signals which are in the direction of your bias, and this bias usually you get it from the trend, the bigger time frame trend. So usually if you get a bigger time frame trend, and then you get these signals, and not just one signal, the RSI, but you get other signals all telling you it's time to sell, usually that confluence and the fact that the market is generally going in that direction, if you are to take that trade, many times that trade will pay out. I'm seeing a question from Johan. Johan, the market can remain oversold or overbought for a long time. This sometimes happens when the trend is very strong. Okay, so when you have a very, very strong trend, the market will remain in that condition for a long time. If it is a seller's market, it can remain oversold for a long time, especially on the bigger time frames. However, if you'd like to take advantage of opportunities, when this happens, you move down to the smaller time frame. You move up down to a smaller time frame, and then you look for entry signals. The entry signals will come if you're in a seller's market. On the bigger time frame, it's in oversold, meaning the trend is strong in that direction. Then on the smaller time frame, you look for a bounce back to overbought, and the market begins to turn down, just like we've seen. So if the market begins to turn down in the smaller time frame, you can get an entry signal there and ride it for a bit, collect some pips. Wait for it again to come back to overbought, ride it again, collect some pips. Because remember, the market does not move in a straight line, but there are always small retracements. So you can pick up on those retracements and make some money. As an example, I'm going to get out of this profile briefly, and we look at something like that. Johan, I'm going to look at that briefly before we move to the next thing. I'm seeing another question from Ringo. Ringo is asking for both RSI and stochastic. what do the MA line indicates when they are widening and getting closer? Ringo, if you are here for the class on moving averages, we saw that as these lines grow further apart, it's an indication of the trend growing stronger and stronger. To take this as an example, the point I'm highlighting now, you see there is a crossover happening, but then as the lines go further and further down, you see that they continue to widen. That is an indication that the trend is growing stronger and stronger. And when the lines begin to converge and become closer together, it means that the trend is weakening. So these are moving average lines, almost the same as moving average lines, which are drawn in the stochastic. So the same way you would analyze the moving average lines is the same way you'd analyze this. One of this is a slow moving average and the other is a fast moving average, just like we saw yesterday. So you can look at their crossover the same way we looked at the crossover in the moving averages. And you'll see these crossover zones usually happen before the market turns. Okay. Ringo, I hope I've answered your question. If it's not clear, let me know and I can go through it again or find another way. Oh, you're saying thanks, so that's clear. Johan, to answer your question, let me pull up a profile. Let's use this profile, okay? And let me just rub away some of these things I had put, and then we start afresh. I'm going to remove these lines because today we're not looking at the moving averages. Today we're looking at the oscillators. And then I'm going to load the stochastic here. I'm also going to load the stochastic here as well. So if you're still with me, guys, okay, this is the pound US dollar. Pound US dollar, we're looking for selling opportunities, if I'm correct. You can correct me if I'm wrong, but most of us have been looking for selling opportunities in this pair. We're looking for selling opportunities because of the fundamentals coming out of Europe or of Great Britain. And also because the dollar is generally very strong right now, we're looking for selling opportunities. So what happens is, if you're looking for selling opportunities and you come here, I need to make this a smaller time frame. Okay. We're looking for selling opportunities. So I'm looking at the 1 hour chart here, and I'm looking at the 5-minute chart here. Okay. Just to give you a perspective of a small time frame and a big time frame. And this is the condition which you've been talking about, I think, something similar to this. Johan, where you ask when the market stays in this condition for a long time, in the oversold, in this case, this is simply an indication that the market is trending strongly in that direction. It is trending very strongly in that direction. That's what it means. Okay. But remember, we're looking for conditions for best purposes, or for stronger moves. Let me use the word stronger moves maybe. We're looking for conditions where the market, remember, we're looking for selling opportunities. So if you see a condition like this, where the market was overbought and then it's beginning to come down in a seller's market, these are good times to begin to initiate your position. Okay. If you are not in a position yet, this would be a good time to initiate your position. Similarly, this is also a good time to initiate your position. Yes, the market, the indicator hasn't reached the overbought situation yet, but the moving average lines have crossed over, okay, and are beginning to widen. You can see this. So at the point where the lines cross over, this is always a good time to begin to sell if you already have the directional bias of a seller's market. Okay, Similarly, you could see that was the same thing that happened here on the 1 hour. So in case you missed the initial entry, but you're looking to get in on the move, okay, what you're going to do is you're going to have to wait for price here to first go back to retrace up a bit and go into the overbought situation. And then you look for an entry to come back down with it. Now remember, on this chart, I've not yet plotted my lines which I like, but if I'm to put those lines, you'll see that they add us, they're going to add us more information. They're going to add us more information we can use. Very good. Guys, you see the power of these lines? Do you see this line? If you had drawn this line at the beginning of your day, let me put that chart here. Let me put those lines on this as well, the pivot point lines. Remember, our bias is in the downward direction, okay? We all know that. Our bias is in the downward direction. So take a look at this. On the 5-minute chart, this is just brilliant, guys. Price came to the R1 resistance 1 for the day on the daily pivot lines. And you see, when price start seeing these price formations here, and then on top of that, you come to your RSI or stochastic, and it's giving you this. Now, that is what we call confluence, okay? This is what we call confluence. The price has come, it is overbought in a seller's market, and we can see it's that this strong supply-demand zone, which we call R1 on our pivot points, and you can see it's beginning to show signs of a downward move. This would be a great time to initiate a sell position, because we can all see that this is happening around a supply-demand zone. We've seen an engulfing pattern happen, okay? And we're seeing the downward pressure beginning to form. Stochastic is giving us confirmation in terms of the moving averages crossing over and them starting to move from the overbought region downwards. So guys, that's what we call confluence. First, prices rejecting the upward motion at the R1. 2, the candlesticks formation are beginning to print bearish sentiment in the market. 3, the stochastic oscillator is showing us the market is overbought and beginning to come out of the overbought region and move back down in the direction that we want to trend. That is what we call confluence. Now, this confluence also we get not from the 5-minute chart, because we're looking at 5 minutes right now, but we get from the higher time frame, or we get from our analysis, which we've already done and got in a directional bias in terms of where we want to move. We want to move downward. So that's the first thing you ascertain. For those of you who are not here in the beginning of the class, we said, when you're going to use any indicator, first you ascertain the direction you want to use it in. And this is a directional bias, which we get when we do our strong weak analysis using the strong weak analyzer tool. It's the same directional bias we get when we do the weekly analysis here on Saturdays and on Sundays and on Wednesdays. So after you have your directional bias, you now come lower and begin to look for trade entries or entry triggers into your direction of the trend, or places where you can exit the market. If there are no questions, I am quickly going to move on and look at the last thing I wanted to present today, and that is called the Parabolic SAR, or Parabolic Stop and Reversal. Some of you might have heard of it. For others, it might be something completely new. So the Parabolic SAR is simply dots that are plotted on your chart and just I'm simply just formatting them, guys. Hey, why have they not formatted? What have I done wrong? Okay, that is it. Sorry about that. Yes. So this is the parabolic SAR. You've all seen where I've picked it from. It's a very, very simple indicator to use. Let me just remove, let me leave the lines. It's going to remove the pivot lines, but let me leave them. Okay. I don't know if they're cluttering the screen, if they're okay. Now, these dots you see at that on your chart, they're called the parabolic SAR, stop and reversal, or stop and reverse. Okay. Now they're used in a very simple way. When the dot forms below the price, okay, that's a signal to buy. When a dot forms below the price, that's a signal to buy. Okay. You see those two dots I've circled? That's a signal to buy. You see those dots I've circled down there? That's a signal to buy. Now remember, in this market, we're looking for selling opportunities. Okay. So if you are in a sell trade already, and three dots appear down here, 1, 2, 3, signaling buy, it would be a good time for you to exit your position or to take some profit off. Okay. However, let's imagine we found the market at this point where we're in a seller's market. There was a temporary rally up, and then we see these dots forming here. One dot. This is a signal for us to sell. It's just that simple. And as long as these dots continue to be here, okay, and to form like this, we continue in our selling position. You see here that three dots did not form. These were only two dots. So we don't exit this position. We only exit it when three dots form. Okay, so because there were only two dots, we remain in the position. So at the forming of these 3 points, that is when we exit our position. That is how the parabolic SAR is used. Similarly, if you're looking for buying opportunities, you do the reverse. It's that simple. Okay. Now, like I said, you do not use any indicator alone. You use them together to get confluence. Confluence means when 1 or 2 or 3 indicators are telling you to do the same thing. So guys, we've added to your arsenal, your trading arsenal, the RSI, we've added there the stochastic, and we've added the parabolic SAR. You should be able to get one of these, use them in combination with the pivot point strategy and with the strong weak analyzer tool, which gives you a directional bias. And when you combine those 3 things or 4 things together with the candlestick formations, which we learned, that is already a powerful trading strategy. You can build a powerful trading strategy and trading plan from that. The only thing now you're missing is how to do your risk management. When you enter in the trade, what lot size to use, where you put your stop loss and all that. And that will be covered on Friday, the coming week on Thursday, when we're looking at the trading plan. the coming Tuesday, we're going to be looking at the Fibonacci, which is another leading indicator similar to the pivot point lines, and we shall add that to your arsenal, your trading arsenal as well. That is the submission I had for you today. If you have any questions, please feel free to unmute yourself and ask, or you can put them in the chat box. Thank you very much, ladies and gentlemen. Julius?
I have a question.
Yes, Johan.
Yeah, I've always had a challenge with when to exit. So you really talked about something to do with the parabolic SAR. Maybe it's something that I would I'm going to be adding to my trading arsenal to help me out in that line. So my question is, okay, like when it comes to retracements, does it really, I don't know, like, okay, there are those retracements. Can't it maybe provide a false maybe signal, or maybe can it really help me to remain maybe in a trade, in a profitable trade, just in case it's just a retracement? You said there are 3 dots. I need to wait for the 3 dots. So I don't know where in the times of retracements, I don't know whether it can really help me out in that. I don't know. It's something like that in that line. Because they are trades that you really want to ride. Yeah, markets don't move in one direction. They always have pullbacks. So I'm just questioning whether the parabolic SAR can really help me out in that direction. So maybe you can clarify on that.
Thank you very much, Johan, for your question and comments. Yes, the parabolic, let me first say this, guys. I'm going to say 2 things. The first thing is that, like we've said, in trading, nothing is perfect. There are no perfect ideal conditions all the time. They will not be there. And if you've been in trading for some time, you realize sometimes you get a good signal. It's actually a good signal, but the market wicks you out. It puts a very long wick and then goes in your direction. But that wick takes you out. It hits your stop loss. For those of us who trade with stop losses, and I pray you all trade with stop losses, the market wicks you out and continues down. This happened to me in gold today, earlier today. Okay, the market wicked me out, and I can show you briefly what happened. And why I'm saying this, Johan, you're looking for perfect. I get the feeling you're looking for something perfect. It's not going to be there. It's not going to be there, but that is why we give a recommendation. We give a recommendation and say, if there are 3 dots formed in the opposite direction, then you should consider exiting your position or taking some of your profits off the table. Okay, I'm a bit scattered now. Maybe I shouldn't have done this because, okay, yes, our dots are still there. So that's the first point I wanted to make, Johan. 1, there's nothing like a perfect condition. Okay, sometimes the market might turn from a simple retracement and then become a full-fledged reversal. So if you are waiting for it to continue down in your direction, it might not. Other times it will. But there's nothing that hurts more than you are in a good profitable trade and then it comes out and becomes a bad trade where you lose money on it. So rather than lose money on that trade, you'd rather take some profits off the table You'd rather reduce on your position. You'd rather move your stop loss in and say, worst case scenario, I don't lose this trade and it becomes a bad trade. At least I take something off it. At the same time, you give yourself room to continue to ride it further. Okay, now let me give you an example using the chart. Jackie, I see your hand is raised. I'll come to you shortly. Using this trade, which is on the chart. Okay, and this is the pound US dollar. If you are lucky enough to enter this trade at the top of this, reversal here, maybe you had the pivot point lines and you came lower on your chart and caught this entry at this point. Okay, if you are lucky enough to. So if you did, and if you see on my chart, guys, I always have 2 time frames. I always have the 1 hour and the 5 minutes. If I'm trading slightly higher, I'll have the 4 hour here and the 1 hour here. Because this 1 hour gives me a bigger perspective, a bigger picture. If I look only at the 5 minutes, I'm going to get tunnel vision. But having this 1 hour still here keeps me in perspective of the overall happening in that, on that pair. Okay, so I have this here. I'm looking for selling action. Okay, I come here on my 5 minutes, I see the selling action, I take this trade at this point. Okay, and when I take that trade, my stop loss is somewhere here above the most recent swing high. On the 1 hour, it will show that the stop loss is maybe somewhere here. And what does that mean? I am saying that if price went against me and came back and went past this point, it means my analysis was wrong. Take me out immediately. Okay, if I were to initiate this trade from this position, okay, maybe on this candlestick, this one, this would mean I'm risking 30 pips and I'm looking to make about 57, 60 pips almost, because I'm looking at this pivot point line as my next point price should at least come and touch. And that is another thing I want to talk about. How do you, because you said you don't never know when to take profits or when to exit. So you see how this pivot point line now gives me another point I should be looking at. Okay, I took this position here and my next target point, okay, is the pivot point line, which is about 60 pips away. Okay, so what gives me confidence to stay in this? I'll be on the 5 minute chart and the price action will be choppy like this. But remember, I still have my dots above here showing me that we're still in the downtrend. So I hang in there, okay? And then when this 1 hour candle closes, so I'm looking at these things together. I'm not looking at only the 5 minute chart. I'm looking at both of them. When this 1 hour candle closes like this, with a Marubozo that is showing strong downward sentiment, irrespective of what's happening on the 5 minute, I will hang in there. When this next 1 hour candle closes as well, showing the sellers are still very dominant, I will still hang in that trade as well. Because remember, what's happening on the 1 hour is more powerful than what's happening on the 5 minutes. So if this 1 hour candle also closes, I know that I am still strong. So I will hang in there. Okay. Now, on this other 5 minute chart, I will begin to see choppiness. You see this choppiness here? So I will be careful and watch. Much as this hour closed like this, I am going to wait and see if I see any strong move coming back up. Then I'll decide whether to take some profit off or not. Now 2 dots form here. I wait to see if a third one forms. A third one doesn't form. I hang in there. The next hour also prints a proper bearish candle. So what do I do at this point? At this point, I will move this stop loss line. This stop loss line, I will move it somewhere here. Why am I going to move it somewhere up here? I am going to move it somewhere up here because the last time price came and dilly-dallied here at the pivot, it didn't go past this point. I could even move it slightly lower, my stop loss. But you get the point. It will be somewhere above this choppiness. Okay? Because that choppiness meant that the sellers and buyers are struggling and the sellers still won. So this would be a good point. Now remember, at this point, Johan, if you entered that trade earlier, you've locked in 40, almost 50 pips are locked in. This trade can no longer go bad. If price were to come back now and take you out, you have your 50 pips locked in. So now you're going to continue riding it. You're going to ride it while monitoring between the 1 hour and the 5 minutes. So you stay in this trade and keep staying in it. You've locked in your 50 pips. See how far you can ride it. Your next price target is going to be this line here, which is the support one for the day, daily support one. This is your next target line. Okay. Now, if price reaches this target line, you can move your stop loss a bit lower and lock in some more. Okay. So remember, on my 1 hour, this is where my stop loss. Now remember, we'd moved the stop loss somewhere here. We've locked in about 50 pips. Okay. If price continues downward, okay, if price were to continue down towards this S1 line, I will move my stop loss further down to this point, somewhere above this point, because at this point, price has attempted to go above, but hasn't. So if price continues down, I'll move my stop loss here. And at that point, I will have locked in some more pips. So I'm managing my trade, not cutting my, I'm now locking about 70 pips. 20 more pips have been locked in. So you use a combination of many things to manage your trade and make sure you remain profitable without it coming and becoming a full-fledged reversal to take you out. Because if that happens, because you never know what's going to happen, but if that were to happen, whether if you're at your computer or not, you've still locked in your 70 pips. It's still a good trade. Yes, you could have taken 100 because probably it came down to 100, but you could have even taken more. So you don't cut your profit short, you leave them trade. You can never be the person who takes the last juice out. So you sacrifice those extra 30 pips with a chance for them to make you another 100. But if it fails, you go home with your 70. There was a hand which was up. I think it was Jackie's hand.
Thank you.
Johan, is it clear?
Yeah, it is. Thank you so much.
Jackie, you had a hand up. Please ask what you wanted to ask.
Yes, thank you so much, Timothy, for today's session.
You're welcome.
And I've seen my best friend is here. Welcome, Jenny, to the swinging team. So my question is, the stochastic setting, does it have to be that, or
No.
what do you think about the 533 stochastic setting?
The default 533 is fine. It will work exactly like this one. There will be no big difference, really. If you know how to use it and you've learned how to use it well, it will still do the job for you and do the job perfectly. Remember, you're not using it in its singularity, you're using it to get confluence together with the other things that we have taught you.
Okay.
Yes.
Thank you so much.
You're very welcome. Thank you for that question, Jackie. It was a good one. Any other clarifications or any other questions? They are very welcome. Okay, there are no more questions. Ladies and gentlemen, I've been your facilitator today. My name is Timothy Chambade, for those who don't know me. We shall have Fibonacci on Tuesday next week. And then we shall wrap up this month by looking at the trading plan, where we shall try to bring everything we've covered in this month together to help you to form a plan that you can use, to draw your own plan that you can use to guide you in your trading or to lead you towards being a profitable trader. For those of you who would like to take this course, we have an accelerated program which goes more in depth and is tailored to you one-on-one, and we can really help to shorten your learning journey and to get you to profitability quicker. Please get in the DMs and to any of the facilitators and they will help you. But the course is going for only $300. That is up to the end of this month. Thank you very much. If there are no more questions, have a good evening and see you on Sunday for the weekly analysis.